not only was I a trader, but for the first couple of years, I would spend almost every night at the library studying and reading about investment and trading, because there was a point where I was convinced that I was going to be able to start a hedge fund. That didn't work out, unfortunately, but I learned an absolute ton about trading and investing, and I'm going to break that down for you guys on why you, the average person, is not going to get rich on the stock market, and chances are you're actually going to lose money if you are an active trader. If you're investing, okay, you can make a decent return, but it's not going to make you rich. You know, your $2,000, $3,000, $4,000 of savings, or even your $10,000, $20,000 of savings is not going to make you, you're not going to get rich off that. And I want to break down for you exactly how that works. So, number one, inflation. Inflation is really just the expansion of the money supply. So the government and actually let's say the Federal Reserve, a private company, just prints more money because money is not tied to gold anymore. It's not tied to anything. There is nothing stopping them from printing more money. And when supply goes up, the money supply goes up, value goes down. Standard economics, right? And the average rate of inflation is about 3%. So every year you're losing 3% of your savings because of financial manipulation. It's a horrendous system when you understand, Federal Reserve and the central banking system, where they loan money to the government. They create money out of thin air, loan it to the government, and the government has to pay it back to them at interest. And the way they pay it back is taxes and selling government bonds. It's horrendously stupid and impossible for any government to pay back their central bank, which is why the U.S. is $19 trillion in debt and counting. But that's another story. At the end of the day, inflation is a hidden tax, and it's one of the worst. It's one of the worst taxes there is. 3% a year inflation. 10 years from now, your savings are going to be worth 30% less than they are now. So every year, if you are investing and trying to, build your nest egg, you're already starting at a 3-4% deficit. Number two, capital gains taxes. So capital gains, for those of you guys who don't know, are taxes that are applied to any profit that you make on an investment or a trade. Cap gains can range from percentage of your ordinary income tax bracket all the way to the entirety of your income tax bracket, depending on how long, the duration of the investment and your annual income in the country of residence. And on average, cap gains will take 10 to 15% of your return. So on the money that you've already been taxed for, when you invest it and you make a profit, you are retaxed on the profit that you make. So when you really break this down, there are just the government has so many hands in your pocket. And when you think you're living in this free society, it's really a joke, guys. But at the end of the day, the cap gains is a great way to help you not become rich in the market. As you can see, when I'm breaking these numbers down for you, there are so many things working against you getting rich. It's no coincidence that America is destroying itself right now, because prior to the 20th century, there was no income tax, and in that 100-year period, America became the wealthiest country in the history of the world, just because they had no predatory government, reaching into their pocket with, at the end of a rifle butt. But now these are factors that you got to worry about, and it's a lot harder to get rich off the market and to get rich off your investments than it was at one point in time. Number three, MER. So it's for mutual funds. If you're investing in funds, Basically, mutual funds are composed of stocks picked by an advisor that attempt to beat the S&P 500. The S&P 500, for those of you guys who are new to this, is basically the benchmark of the top biggest and best 500 American stocks. And it's changing every year to reflect, changing market caps and things like that. The majority of the funds out there actually underperform the S&P. And I worked at a mutual fund company prior to becoming a trader in the e-business department. And part of what I had to do was, all this work on the site, and going through, you could see how much every fund returned. And what the company would do is they would take off the underperforming funds off the site, because no one wanted to see -7%, -8% when the market's doing something like 5%. The average fund was only doing like 3%, 4%, 5%, where at that point the S&P was returning like 8%. And this is a fact across the board. The majority of funds underperform the S&P. And by the way, guys, you can buy the S&P 500 index. You can buy it as an index fund. You can buy it as the Spiders, which is actually it trades like a stock that is linked to the value of the S&P. So you've got a couple ways where you can buy that. But when you buy a fund, 9 times out of 10, it's going to underperform the market, because the guy who's running it doesn't know where the market's going. No one does. No matter how smart he is, he could have graduated from Wharton School of Business with honors. It doesn't matter. That he's gambling, and if he has a different portfolio than the top 500 stocks, thinking that he can beat the market, 9 times out of 10 he's not going to be able to do it, because he doesn't fucking know where it's going. And when it comes to MER, management expense ratio, a lot of the time they're going to charge you 2.5% just for the privilege of mismanaging your money. The fund company that I worked for, it was 2% flat rate across the board, whether they made money or not. And this wasn't out of your profit. This was straight across the board. 2.5% of the assets you had under management, the assets you had under management, 2.5% of that was taken from you every year. So you had the 3% inflation rate, and then you had another 2.5% taken from the mutual fund company. So you'd have to earn 5.5% just to break even by investing in one of these pieces of shit. Okay? And a lot of the time, these guys are going to charge you front-end loading fees and back-end loading fees. So that means they'll charge you a fee to come on board, something like, 1%, 2%, 3%, and then they'll charge you something on the back end. So a lot of these things are hidden from the average investor, and the average investor only looks at what their fund did. They get the prospectus at the end of the year, and they look at, oh, okay, my fund did 6%. That's great. And they go to the dinner party and they brag about, I'm with this great mutual fund company. We've been returning 6%, every year. But they don't realize that the market might have done 12% that year. It's amazing how people invest their money without, any kind of thorough, objective analysis. They sit down with a financial advisor. He seems like a respectable white person in a suit, and they say, all right, here's my savings. You've got a big office, and this is a very respectable looking company, and these guys, these are the ones who are going to take care of my money. But the guy you're sitting down with is a fucking salesman. Hands down, our biggest department in my fund company was marketing. Marketing had 2 floors where every other company or where every other department had maybe half a floor. Okay, because these are sales organizations. That's how a mutual fund company survives.